In this video, guys, we're going to look at being a trader and an investor at the same time. Is it possible? Hey traders, a very warm welcome to you, and investors, a very warm welcome to you. Subscriber, welcome back to the channel. If you're new here, a warm welcome to you also. Okay, so is it possible to be a short-term trader, whether you're a swing trader or a day trader, and an investor at the same time? We know that it's two distinct different skill sets, right? There's a lot of kind of congruency between the two: risk management, allocating capital, making trading decisions, identifying opportunities, but ultimately they're two really quite distinct skill sets. So I've put together some do's and don'ts, which I think you should listen to or adhere to or kind of take heed of, for want of a better word, when you're thinking of trading and investing. It's a challenging thing to do, but it can be done. So first of all, have separate accounts. Don't stick everything in one account and say I'm investing in some and I'm short-term trading. Have two different accounts. You probably will have to anyway, because you're probably going to allocate more capital to your investing account than you are your trading account, because likely you're trading on margin, likely you're investing cash assets in the shares in whatever you're purchasing. So having two separate accounts, there's a distinct separation there. You can see the performance, you can see everything far more clearly. Define times for each. What do I mean by that? Define times when you're going to research your trades and when you're going to research your investments. By all means, sit at the desk at the same time, but say, hey, you know what, an hour for my trading research, stop. Now I'm going into investment research mode. It's too easy to kind of mix it up and flick through charts and go, oh, that would be a good short-term trade. Oh, that would be a good investment. You want to be very clear on what you're looking for and very clear on what you're doing. Same when you're managing your positions. I'm managing my trading positions now, done, give myself a break, come back, now I'm managing my investment decisions. It helps your mind switch into different gears, because what you don't want to do is start clouding the two, because you'll start looking for trades to turn into an investment, which is generally a very bad idea, or you'll have investments that make money for you very quickly and you'll take it and think of it as a trade. And both of them are very, very bad, because both times your thesis is completely different to what you've done. So avoid that at all costs. Okay, create as much separation as possible. Just kind of touched on this, but I thought I'd put it as an actual do, is whatever you can do to create the separation, the separate accounts, the separate times, the way you approach it, and most importantly, and I put this in the don'ts, but it's kind of the combination of the two, don't trade or invest in the same market. What do I mean by that? So let's say you're investing in a FTSE 100 tracker, okay? And then intraday, you're shorting the FTSE 100. The problem you have there is that one side of your mind saying, hey, I think the FTSE is going up for the next 5 years, so I've got this tracker fund. The other part of your mind saying, hey, I think the FTSE is going down for the next 3 weeks, I'm going to go short. Now, if you can separate that, fine, but many people struggle with that and say, well, actually, all I'm doing is kind of hedging the position that I had there. Why don't I close that off? Why don't I close the tracker and make some money from my short? And they try to be too clever about things. And this is kind of the third point here on don't. Try to be too clever, like, oh, I'll close that position there. And it's the same perhaps if you are invested in, let's say you invested in Dow stocks or technology stocks, and then you're day trading the NASDAQ, for example, or you're day trading the Dow futures. You'll still kind of know in your mind the exposure you've got. Hey, I'm pretty much exposed to a long NASDAQ position here with my 5 or 6 tech stocks in the NASDAQ. I'm shorting the NASDAQ futures. I'm kind of creating a conflict. So creating as much separation as possible. Perhaps you have a portfolio of stocks or shares in your investment portfolio, but you also say, you know what, I'm going to trade crude oil, I'm going to trade gold, I'm going to trade the currencies. Completely uncorrelated. There's some correlation there, but really the separation is massive compared to trading the index that they're in. So in other words, your performance doesn't matter. You're not thinking about this. You're not thinking about your other portfolio of stocks. You're just looking at those purely from a trading and speculation perspective. Final one of the do's, guys, is specify the risk levels for each. What I mean by this is, okay, you've got allocated capital for investing, allocated capital for trading. What danger you have is, let's say you have a very good month in trading, you then kind of, and this goes with the don'ts as well, keep moving funds around. You might then put that money into your investment account, and then let's say you have a poor month in trading, and then you're like putting your money back in from your investing account into your trading account. Or let's say your trading is just very bad and you just keep topping up from your investment account. That really isn't defining your risk. You kind of don't know where you are. And even your investment might have a poor month, might have a poor quarter. really you've got to know that the game is different, right? I'm riding out the ebbs and flows of my investment. I'm investing in something that I believe is going to increase in value over the long term. I can ride out the short-term waves. If you've got your short-term head on, you don't want to ride out the short-term waves. You want to capitalize on them. So, not moving funds around and defining the risk levels to reach. Hey, I'm going to risk X amount of £1,000 on my trading. Hey, my maximum drawdown in my investing portfolio is X before I start to regroup and redefine what's in the basket. That kind of thing. Distinct separation again, and defining key risk levels for each. What haven't I covered here? Not investing in the same market, covered that one. Turning a trade into an investment, covered that one, and vice versa. That's the biggest mistake I see a lot of people make. Trade goes against them. They go, you know what, I quite like the company anyway. Let's stick it in the investment drawer. The thesis is completely different. You might get away with it, but the habit is bad, and eventually that'll come back to bite you. Trying to be too clever, like I say, trying to move money around, or trying to kind of second guess, well, I'm short in the FTSE here, maybe I should cover my tracker fund here, maybe I should add this, like that. Distinct separation, being very clinical about it, and moving funds around, bad idea as well. So the summary of it, guys, is hey, if you can do it if you have that separation. The more separation, the better. That's the theme running through all of these. The account, what you're trading, the way you're approaching it, the way you're analyzing the time that you're dedicating to it. Distinctly separate the two, and then you can run two side by sides. When they start to come together and it starts to be that cloudy area of my trading and my investing, where's my time spent, where's my capital going, what am I risking, that's when it can become dangerous, and that's when it becomes very difficult to become a trader and an investor. All right, guys, take care, keep the risk managed, whatever you're up to. Stay tuned for the next one. See you later. Bye-bye.